Oh, today we're looking at a very bullish investment report on IREN Ltd.
Yeah, it's focusing on that huge recent surge and this projected path to $100.
All driven by that pivot to high-performance computing and, of course, the big one, the $9.7 billion Microsoft AI contract.
Okay, so let's dive straight into the opening because I think the primary challenge here is it's really structuring the report to manage the tension.
The tension between the headline and the actual analysis.
Exactly. That headline, IREN explodes plus 15%, rocket next stop $100. I mean, that is pure gold for video engagement, for clicks, absolutely.
No question.
But are we leading with style or with substance? That's the thing.
Right. And as it stands, the material opens by focusing so intensely on the technical move itself.
The Korean breakthrough that $42 resistance level.
Which is a great signal. It screams institutional buying. It's strong evidence of market interest.
But making that price explosion the first thing you read, it just delays the foundational context. It doesn't tell you why it exploded.
That's clearly laid out. And that sequencing, leading with the plus 14, almost 15% surge, that's the core weakness right there.
It is.
It just risks framing the whole report as, reaction-driven hype, like investor mania is driving the analysis.
And that immediately makes a sophisticated investor skeptical. You risk undercutting your own credibility, which is built on that really robust Q1 data you have in here.
I mean, the revenue plus 355%, that huge $1.08 EPS beat, that's the real story.
Yeah, if you start with the excitement, the reader has to work backwards to find the justification.
And the report has this fundamental institutional-grade strength, but it's just buried under a headline that feels, designed for retail excitement.
If we want this to be the anchor for a path to $100 thesis, we need conviction, not just momentum.
So the suggestion for improvement here is pretty critical. It's just reorder the initial narrative flow.
Simple as that.
You have to prioritize the fundamental catalyst that drove the move. That's what justifies the market's repricing of IREN as an AI player.
You want that deep expertise investor to feel immediately validated.
Exactly. They need to feel like their existing knowledge is being confirmed, not that they're being clickbaited into some speculative argument.
Okay, but let's push back on that for just a second. Is there any merit at all to leading with the price move? I mean, doesn't it immediately grab your attention and establish that something big happened here?
It establishes that something big happened, sure, but it doesn't establish why they should trust your analysis of it.
Okay.
Look, we know the investor reading this is already deeply familiar. They saw the stock move. They don't need you to tell them that.
They need the why.
What they need from a high-conviction report is the immediate, fundamental why. So if you lead with the Microsoft partnership, a $9.7 billion contract, that is objective, it's measurable, it's a long-term commitment that fundamentally changes the entire business model.
I agree. So instead of opening the report with, the move.
You lead with a catalyst, the execution of that Microsoft partnership.
Right.
Precisely. And then you use the stock's massive surge, that 15% explosion, as the market's validation of the whole HPC pivot, rather than making it the main subject.
That's a great frame.
It reframes the surge as a logical, fundamental reaction, and that appeals directly to that expert investor. It turns the price action into a consequence of their strategic success, not a cause for, temporary speculation.
That shift alone elevates the entire piece from a technical commentary to a real fundamental deep dive.
Yeah.
Okay, so let's move on. The next structural hurdle. We have to talk about justifying the valuation, especially for aiming for that $100 forecast.
It's ambitious.
To hit that ambitious target, the report has to more aggressively define and defend IREN's standing as a Tier 1 AI cloud infrastructure player. It needs to move beyond just general peer comparisons.
And explicitly link their infrastructure capacity to their valuation.
Yeah. As I understand it from the notes, the core argument here is that the stock is, it's undervalued compared to peers like CoreWeave. Assuming IREN executes on both the 30-plus exahash mining capacity and fills its new AI data centers, that's what supports the $82 average and 136 high targets.
And the pivot itself is validated by the Microsoft deal, the sector tailwind, Amazon's $50 billion push.
Right. The sentiment is strong.
But while the sentiment is strong, we run into a major issue with the financial clarity backing it all up.
Yeah.
The financial deep dive is impressive. It really is. but it doesn't cleanly delineate which of those Q1 metrics are from the new AI business versus the existing Bitcoin mining operation.
Which is still a huge legacy chunk of their cash flow.
Exactly.
And you're pointing to the net income figure, aren't you?
Yes, specifically that record high net income of $384.6 million. It includes what's labeled as likely favorable Bitcoin revaluation.
Likely is not a word you want to see there.
No, that uncertainty can really muddy the narrative of core, repeatable profitability. I mean, when you're making a Tier 1 valuation comparison to companies based purely on service contracts, introducing volatile crypto revaluations, it contaminates the message.
It just allows a skeptic to dismiss the whole thing.
Right. They can just dismiss the net income as a temporary accounting boost rather than a real signal of operational success.
That's a critical challenge. When you're asking an investor to project 100% upside based on a new business model, you need crystal clear, verifiable metrics. You can't rely on these temporary accounting windfalls.
Absolutely not. So our suggestion for improvement here really pivots around the balance sheet.
Okay.
You have to isolate and strategically leverage that massive, roughly $1.03 billion cash pile to bolster the AI narrative.
Make the financial defense of the targets more compelling.
And less reliant on analyst ratings or, what the price of Bitcoin is doing that week. The cash is hard. It's a liquid asset that speaks for itself.
I hear that, but let me introduce some friction here. Why focus on the cash pile? Couldn't someone argue that's just residual wealth from their legacy business? Shouldn't we be doubling down on the forward-looking growth metrics, like, say, the potential annualized revenue from the Microsoft contract? Is there a risk that focusing so much on the cash might overlook the potential of the new AI infrastructure growth? I mean, we need to fully make the case for Tier 1 status based on the future.
That is an excellent challenge, and it's why we need to change how we present the cash.
Okay.
We use the cash pile not as a residual asset, but as an immediate strategic growth lever. In the current environment, what's the constraint for any Tier 1 AI player? It's not demand, it's hardware supply. It's NVIDIA GPUs.
So the cash is their competitive edge for securing that supply?
Exactly. And here's how you make that concrete for the reader. You explicitly link that $1.03 billion cash pile to an immediate competitive advantage. State it clearly.
Spell it out.
This cash allows the company to buy more necessary NVIDIA GPUs and build out critical infrastructure without immediately resorting to heavy shareholder dilution.
Which is a huge operational and financial advantage in a capex-heavy sector.
Massive! Smaller players are constantly raising money. This transforms the cash from just a balance sheet number into a strategic shield against dilution.
That is a very powerful pivot. Okay, so how do we handle that massive $384 million net income number without, undermining investor trust?
So whenever that impressive number is used, because it is an impressive number, you can't ignore it, the caveat about the favorable Bitcoin revaluation has to be placed prominently early in the analysis.
Just be transparent.
It shows transparency. It maintains trust. And then you pivot the discussion immediately to operating profit. Focus on the EBITDA of $91.5 million.
Right.
And you define that for the audience as the core, repeatable profitability signal for the AI business growth. That 36 times jump in EBITDA, that's the true, clean AI operational fuel we need to highlight, insulated from crypto volatility.
That really clarifies the profitability story. Okay, let's move into our third major area of focus, risk.
The big one.
The $100 forecast is ambitious, and the risks need to be transformed from a compliance checklist into an integral part of the investment thesis itself.
Yeah, the list of risk factors, CapEx, execution risk, Bitcoin volatility, it has to be an active, analytical stress test that actually guides the audience's understanding of that path to $100.
Let's look closely at that section. The material accurately notes the two critical financial risks: the extremely high cost of building AI data centers,
The massive CapEx.
and the current financial consequence of that, which is represented by the negative free cash flow of minus $125 million last quarter.
Right. The report says they're spending money to make money, which is true for growth, but
the risk is presented separately from the forecast logic. It's isolated.
And that isolation is the key weakness. For an infrastructure player aiming for a $100 valuation, managing this cash burn is maybe the single most critical factor for near-term performance.
And investor confidence.
Listing the negative free cash flow, they're burning $125 million more than they're generating just to operate and build, and listing CapEx as independent risks diminishes their urgency.
It makes them sound like boilerplate text.
Exactly. not like the immediate, actionable threat that could derail the entire thesis if execution falters.
So how do we fix that isolation? How do we integrate the reality of that cash hemorrhage into the price targets themselves?
The suggestion is to use the critical resistance levels in your path to $100 forecast as execution milestones.
Okay.
This gives the audience actionable, forward-looking metrics to monitor instead of just abstract risk factors.
You're converting the risk into a trackable performance hurdle.
That's it.
That makes logical sense. But let's challenge the timeline a bit. Could the evidence also support a different conclusion? Like, maybe that the CapEx burn accelerates faster than expected because GPU costs are rising, and that pushes the timeline $400 further out?
It could.
So how do we use those targets to manage those potential negative expectations?
We use them as explicit performance hurdles that justify each step up in the valuation. So you restructure the next stop logic to directly integrate the risk.
Give me an example.
Okay, for instance, you link the first psychological resistance point, $50, to proving they can deliver on the initial phase of the Microsoft contract without technical hiccups or major procurement delays.
So getting past $50 isn't just about market sentiment.
No, it's about proving early execution capability.
So the $50 target is essentially the validation of their execution risk management. Okay, what about the big jump to the 52-week high?
You frame the next resistance at the 52-week high, 76.87, as strictly contingent upon showing a clear reduction or, at the very least, a stabilization of that negative $125 million free cash flow in the next report.
Ah, okay.
If they can show operational leverage, meaning the new AI revenue starts kicking in and offsetting the CapEx spend, that validates the move past 76.87.
And if they don't?
If that minus 125 number balloons to, say, minus 250, then the path to 76.87 is immediately questionable, regardless of how big the Microsoft deal is.
That is incredibly strong. It forces management to be accountable to the price targets. It converts the financial risk, the cash burn, into a concrete performance hurdle the audience can actively track.
Which is exactly what a sophisticated investor demands.
It makes the investment case so much more rigorous. Okay, so to summarize the 3 critical areas for improvement in this IREN report.
First, reorder that opening sequence. You have to prioritize the Microsoft deal and the AI fundamentals over the price explosion.
Right, the fundamentals justify the surge, not the other way around.
The surge should never be used to justify the fundamentals.
Second, you have to use that $1 billion cash pile strategically. Frame it as their non-dilutive GPU procurement advantage.
And be sure to clarify the net income figures by front-loading that caveat about the Bitcoin revaluation.
Which creates a much more robust Tier 1 AI player thesis centered on core operating profitability, like that 26x EBITDA jump, not just crypto prices.
And finally, transform that risk section. Integrate the high CapEx and the negative free cash flow risks directly into the path to $100 as performance milestones.
Use those resistance levels, $50 and 76.87, as explicit proof points for flawless execution and stabilizing that cash flow.
Exactly.
You implement these structural and clarifying changes, and you elevate this whole analysis from a momentum-driven video thesis to a deeply analytical investment